Cool. All right.
All right.
No, that's I mean, especially when you've got like investors' money and like other stakeholders. I'm sure they're asking those questions. What are you guys doing about this? What are you doing about that?
I don't know how much you've played around with it, but have you played around with coding or heard anybody?
I mean, I've played around with, and I'd say I've done a little more than play around with it. Like I've been using ChatGPT a lot to like kind of like automate some of our tasks, but no, I'm not coding and stuff like that.
So like, I think the most fascinating, I mean, ChatGPT was very impressive, don't get me wrong, but the most fascinating use case that I've seen so far is AI's ability to write software.
Yeah.
And I think like where the world is going is enterprise software companies will be quickly displaced with what I would call single-use software applications, throwaway. Fire up software like you fire up a server.
Yeah.
It could write code so fast and so efficiently, and it does a very good job writing new code as opposed to sort of refactoring old code.
Yeah.
That like if you wanted, to write a piece of software to manage your podcasts for a month, you can literally do that and then just scrap the whole thing when you're done.
Unbelievable.
And that really that becomes a game changer because the equity is no longer in like what you're building.
Right.
To recreate Salesforce or Oracle, right? It would take a massive amount of money and huge teams of people and years, but with AI, it doesn't.
Yeah.
Right. And I'm not suggesting AI is going to replace Salesforce overnight, but the idea that you write software and then try to scale it through replication, I think that idea goes away in 10 to 20 years, and it's more about writing custom software for one use case and be willing to throw it away when you're done.
And then just when you get to the next level, like write a different software.
Just write it again. Yeah.
Oh my gosh.
Because like we are doing things now that would take, with no exaggeration, months we can get done in hours or days.
Oh my gosh.
So it's worth it for us to actually build things with the intent of scrapping it to either test use cases or go down a path to see if we like it, and then completely back out and do something different. And you couldn't do that before. You had to commit before. Mm-hmm. So it's crazy where all this AI stuff's going.
So how long has Approve been around? And before it was Approve, it was Quipped, right?
Yeah.
So
we started Quipped in 2015. So we're 10 years now.
Okay.
And then we essentially pivoted, which I hate, I like the word evolve, but we evolved the company into Approve in about 2020. And I say evolve because pivot kind of implies like you went down a certain path and then you made a mistake.
Directions.
Right?
Yeah.
Like we could not have gotten to where we were at if we didn't go down that path.
Right.
So we had to go down that path.
Right.
But we're year 10 right now.
Okay.
Yeah.
And so in the business model is it's leasing and financing equipment for. I remember when we talked last time, it was more around like restaurants, but is it for any type of business?
No, it's restaurants is a segment.
It's one of the vertical segments.
So we are in the equipment finance industry.
Okay, equipment finance.
Equipment finance is the way to think about the type of equipment that could be financed through equipment finance loans and leases and agreements is any equipment that's essential to a business.
Got it.
So if you're a coffee shop and you want to buy an espresso machine because that's how you're making your money, you can finance the purchase of that espresso machine for us. But if you wanted one for Component Associates, we probably couldn't do it because it's not essential to your business.
Oh man, dude, I was seriously thinking. I've been trying to come up with a good coffee solution, and I was like, you saying that, I was like, oh man, I could finally get that like $12,000 Italian espresso maker.
No, it's got to be. Now listen, if you start selling coffee, if it's Component Associates and coffee,
okay,
or Capone's Cafe, we're good to go.
Okay.
But,
okay, so it's got to be essential to your core business.
Yeah.
Okay.
Which is big, right? So in the U.S., it's about $400 billion a year worth of equipment is financed, and that's what the industry would call small ticket. So assets of $250,000 or less in value.
Right.
So the way I sort of think about it, it's everything but planes, trains, and automobiles, right?
Okay.
And that's the industry as a whole is probably 1.2 trillion.
Insane.
It's a massive number.
Yeah, that's.
Yeah.
It's big.
Yeah, it's very big. It's very big. So we do food service equipment, food service and restaurant. We do construction, engineering, you know, land surveying, entertainment. You know, like playgrounds. Like
Yeah.
It's just, you know, if you're in a playground business, right? Gaming. So it's quite broad.
Okay.
Yeah.
And then so your business model is, so I'm a small business. I want to outfit a new restaurant. I want to buy a bunch of equipment. You guys serve as like the platform that can connect a business that needs to buy something and somebody that sells it, but then offer the financing solution in the middle.
Yeah. So really confusing, right?
Okay.
We are a firm for business.
Okay.
So you're familiar with a firm, buy now, pay later. You know,
Oh, a firm. Yes,
so you
yes,
can, like,
yes,
finance your Airbnb, right?
yes. Yes, exactly.
We're like a firm for business. So what we do
Okay.
is we partner with equipment sellers.
Okay.
These could be manufacturers and distributors that are selling equipment. We become their in-house financing department. So when their customers want to purchase or finance the purchase of equipment from them, they're using the approved platform.
Got it.
We're not a direct lender. So unlike a firm, we have a network of lenders that we have partnered with that provide the actual financing. So we're an origination partner for them.
Got
Yeah.
it. Got it.
And the connecting of buyers and sellers, that was the Quip model, which we still operate Quip, but of the 40 spot employees, we only have 2 people working on Quip today.
Okay.
So what we did though is we built this financing engine for Quip early on, and then our sellers are on the marketplace. We're saying, you know, hey, we really like the way this equipment finance engine works on Quip. Is there any way we can use it with our own customers? And that was sort of the light bulb moment for us. So we ported out that technology so that they can embed it on their website and embed it around their quotes that they were sending their customers, and then we didn't have to worry about finding the demand. You know, it was their customers that you know, were financing the equipment, and that was a more scalable model than trying to build a marketplace.
If you were to label your company with like, you know, like if I were to say like, what type of company are you? Like, what type of company are you guys?
So we're a fintech.
Okay.
Right. So by definition, fintechs are companies that are embedding banking products into other workflows, right?
Right.
So the way we think about it is we're a sales enablement solution for these equipment sellers. We help them sell equipment, and hopefully we help them sell more equipment than they would if they weren't using us.
Right.
And then, you know, while we get involved in various aspects of banking workflows like underwriting and stuff, at the end of the day, it's our banking partners that make the final underwriting decisions on who's going to, you know, and then they're the ones that service the loans after we originate them. So, you know, the equipment finance industry would call us a broker, and then, you know, we kind of think of ourselves as a sales enablement tool for our equipment sellers.
Got it.
Yeah.
It sounds like a really scalable
Very scalable
solution.
It's it's $400 billion a year,
Yeah.
right? That's the market size. There's probably 120,000, you know, addressable equipment sellers, you know, in the United States, you know, there's other products that can be. We're weaving in other products like working capital, for example.
Mm-hmm.
So after companies get financed, get their equipment financed, we sort of follow up with working capital options for them if they have a need. Usually, if you buy a piece of equipment, it's because you're expanding or growing. So it's like, I bought a piece of equipment, now I need the people to actually run it.
Yep.
And so there's other products that can be offered into it.
So are you guys doing any like actual underwriting, or are you just gathering the data on behalf of the bank for them to do their underwriting?
We pre-underwrite, but we're not making decisions. But
Okay.
what we do is we are collecting, like we'll do credit soft pulls. We're validating Secretary of State data. We're doing various. We're putting third-party data sources in to do to sort of enrich our applications that we're getting from the customers. But the point of all that is to build a sophisticated model so that we can match people up with the right lenders, right?
Yeah.
It's not a shotgun approach. We're not taking an application, sending it out to 10 people and saying, that's the lending tree model. That's not what we do, right?
Yep.
We know exactly, based upon data, it's a very data-driven machine learning model we built. We know exactly what lender is the most likely lender for a particular applicant, and we kind of waterfall it down that list.
Brilliant.
Lenders will tell us we are really good at doing X, Y, and Z. Like we're near prime in this asset size and this asset class, so on and so forth. And we're like, no, you're not. Our data says something different, right?
That is hilarious. Oh my gosh.
So, but it's we think of the lenders as our customers too, right? So, we have three customers, right? We have the borrower,
Yep.
we have the vendor, and we have the lender. And what we don't want to do is waste the lender's time with unqualified opportunities. So we really try to cultivate the right opportunity for every lender.
Brilliant.
Yeah.
And one of my next questions was going to be who is your customer? But you answered that. And so where do you focus most of your marketing and strategic account management between those three, would you say?
So the vendor is our first customer,
Okay.
right? And the vendor is while it's the way we generate revenue is transactional on every deal that gets originated, it's the vendor that's providing sort of consistent stream of those transactions.
Yep.
So think about like a merchant bank that's partnering with a retail store. Every transaction, it's a transactional model, but they're looking at that retail store's ability to drive credit card transactions over the course of a year, and they can say, okay, this is $1 million account, right?
Yeah.
So the vendor is our first customer.
Okay.
The applicant it's a transactional thing. We walk them through origination, and
Yep.
then at that point, it's not. There's not a lot of repeat business. We do have repeat business, but it's not a core focus of ours. And then the lenders are like our strategic partners, right? So, we want to provide value to them, but they also provide value to us. It's sort of mutually beneficial.
Yeah.
Well, we only have a handful of lenders. It's the way we build the business is by going out and getting those vendors.
Smart.
Yeah.
And I can imagine that, helping the bank almost with their underwriting, like doing pre-underwriting, I'm sure that's a value add for the bank as well. Like if they don't have the software or the resources or the time, you're helping build that customer profile.
The challenge with, I think, any banking businesses is they want to maximize approval rates because that means they're doing more with less, right? Like if I had 100% approval rate, that means every single person that applied to get a loan is qualified and I can loan money to, but that's not reality.
Right.
So if it took 100 people to apply to find one person qualified for borrowing, they probably wouldn't find profitability in their model.
Yeah, exactly.
So our goal is to maximize approval rates to the extent that we can, so that their time's not wasted, their resources aren't wasted, and we become a valuable origination partner for them.
Got it. I'm just thinking about your business model and the importance of having software in your business model. It sounds like there's software needs across the whole chain of events there.
There is, and to understand the value of the software and the tech, you have to understand how this business was done before.
Yeah, how was it done in the past?
So lenders would partner with a vendor, and it was a very referral-based manual partnership. So
Yep.
if you wanted to finance your espresso machine, you'd go down to Cape Fear Restaurant Supply.
Yeah.
He'd quote you a machine, and he'd say, "Oh, if you want to finance it, give John a call over at wherever, Live Oak Bank, right?" And once that referral takes place, if you're the seller, it's a very disruptive process because it's like, okay, Chris is now going to go talk to John. I don't know how long that conversation's going to take. I don't know what the application's going to be. I don't know if he's going to get approved. I don't know if he's going to like the rates. And I'm going to call him in 2 weeks, and I'm going to find out that he got frustrated and bought a cheap espresso machine someplace else.
Yeah, exactly.
So they don't want to do that. They want to keep control of the sale. So what a lot of vendors have done historically is, sort of resist financing, like not bring it up unless the customer was insisting on it, right?
Yeah.
What we're trying to do is lower that friction, lower those barriers, and get salespeople and sellers to think of financing as an enablement tool, not a point of friction. And the way we do that is one, give them full transparency in the process. They have a portal that they can log into. They see all the information about the application. They see where it's at in underwriting. All the CRM notes that our loan officers are taking as they're talking to the applicant are there. They have access to everything. They are at the underwriting desk, right?
Yep.
And that makes them feel comfortable. Two, we are building sort of intelligent technology around predicting outcomes. So it may take a few days to underwrite and sometimes lenders need additional information above and beyond what's provided, and then it takes a day for the customer to provide bank statements or tax returns or whatever. But we have a machine learning model that attempts to predict approvability before, just based on what's on the initial application. And we'll say, based on what this customer has told us, self-disclosed, all of which needs to be validated, of course. There's a 97% chance of approvability in our network. And if we tell the salesperson that's selling the equipment that up front instantly, then that gives them the confidence that equipment financing is an enablement tool and it's not going to get in the way.
Right.
So it's pretty cool what we can do with the tech.
Yeah, no, so it's amazing to hear. Like, when you say machine learning, is that AI or is
by definition it's a form of AI. It's not the Chat GPT,
right.
LLM type stuff. And machine learning's been around for a while, but it is a form of AI that statistically tries to predict outcomes.
Yeah. Now I'm thinking about it. We talked about my experience in the boat industry and the financing on that. What you described as, I'm going to go look at this asset, and my salesman's going to tell me to call Johnny down the street, and then I'm hitting up Johnny every single day, like, hey, how's my customer doing? Like, is he approved?
Chris, stop texting. Chris, stop texting.
Yeah, exactly. Man,
that's exactly the experience.
Yeah,
and that is like the way we have this sort of vision of how do we make equipment finance as easy as taking a credit card.
Yeah. Right.
So it's like, hey, just why don't you pay with cash? It'll be easier. You can drive your boat home today, right?
Yeah, exactly. Yeah.
And we're there's a use case where we're not far from that. We have for a certain credit profile, certain asset class, we have, when a customer applies, we have API connections into certain lenders. They have instant decisioning. It can come back with an approval. The customer can select the term, and then docs can get created. And for a segment of what we do, that's a reality.
Yep.
And that is a shopping cart style checkout process for applying for and getting approved for a 60-month loan.
Yep. And the automation that you guys have built around all that's insane.
Yeah, it's pretty cool.
It's really cool. So building a business is extremely difficult, and I'm sitting here like thinking like, man, if I was in an industry where I had to like be on the cutting edge of AI and software, like I'd be scared. To sit like bookkeeping and fractional CFO, like yes, there's definitely disruption like with AI and all that stuff, but like what you guys are doing, like it's you're really on the cutting edge. Like how do you stay like on the cutting edge, or like how do you stay up to date with what the heck's out there and what's going on?
It's a good question. I think you have to. I think you have to surround yourself with like-minded people that are thinking cutting edge. And it's easier to do that in some industries than others.
Mm-hmm.
Some industries, it's not so much about being cutting edge as it is about conforming to convention or precedent.
Mm-hmm.
Like law, you can't just innovate law. Like you can't create new laws.
You definitely cannot innovate law.
We're going to spend 98% of our time looking at case law to see if this decision's already been made, so that we don't have to make it.
Right.
And then 2% of the time, maybe making a new decision that's never been made before. Right?
Yeah, exactly.
So I think it depends upon the industry as well. But we have no choice. You have to figure out innovative approaches to doing things that gives you a competitive edge. And oftentimes if you want to get a competitive edge from an operational sense, you got to figure out how to do more with less.
Exactly.
Right. So, and I think your industry is a good example of some serious disruption that doesn't. I don't think the industry goes away, but it has to change.
Definitely.
So I'll give you an example. Right now, out of the box, without being a technical person, you can create an AI agent that integrates with your QuickBooks, that goes into QuickBooks, looks to see who's 30 days past due, and then it's connected with your Outlook, and it sends them an email saying, hey, you're 30 days past due, right?
Yeah.
Traditionally, that's a bookkeeping type of job,
yeah.
Right? So that's not something that you necessarily need to do anymore, but knowing how to set up those AI agents for your customers probably is something that needs to be thought about,
Exactly.
right? Which we should probably talk about that.
Yeah. I've got a couple things I'm taking notes on that we should talk about.
Yeah.
But no, that's a perfect example. So we're talking. So where Approve is today. I mean, you guys have built, this incredible platform. You guys are you're generating revenue. How long have you guys been generating revenue for? Like you started
10 years.
10 years. So you were generating revenue from day one-ish.
Yeah. I mean, we spent some period of time, 3-6 months early on building.
Right.
But focused on generating, if you're not generating, that's how you validate what you're doing as a startup, right? Like I've always said, earning the first dollar in any business is a lot more difficult than earning the millionth dollar.
Yeah.
It's also a lot more fun for me, right? But that's the hard thing to do. Like, how do you convince somebody
to pay for the service?
Give me what you perceive to be valuable for something that I have, right?
Yeah.
And that's the most difficult thing to do. I to this day, like, because we have new products and services and stuff we're always sort of experimenting with, but the excitement of generating that first dollar for me has always been like much more satisfying than the millionth or 10th millionth or 50th. At that point, it's old.
Yeah.
It's easy. A million people have already given you $1.
Yeah.
Why wouldn't the 1,000,001 person give you the $1?
Right, exactly. Exactly. So when you were building, did you guys take on investors like right from the beginning, or did you kind of bootstrap it and generate some revenue and then go out to the market? Like, give us the background on that.
So we very early on we bootstrapped it with our own money, time and money.
Yep.
We did go out and get angel investors early on.
Yep.
I was able to leverage an investor that had invested in my prior business who did well in that.
Yep.
So
that helps.
It was it was an early conversation that didn't need a whole lot more than my word but when we got serious about raising meaningful money, that was about going out into the region, networking. We raise money from angel groups. We have early on we had a series of high net worth individuals locally, primarily in town, and then we leveraged that into raising money from angel groups, primarily through Venture South, which made it very efficient.
Mm-hmm.
But that's the more traditional, startup. Dog and pony show, get up on stage, pitch, answer questions, get harassed.
Yeah, exactly.
And did that for a while, and I think the biggest thing I learned from raising money, and this is probably like the biggest piece of advice I give people that have not done this before.
Mm-hmm.
If you want to raise, if you think you need to raise $1 million, you need to get $1 million. You can't go out and raise 100 here, 100 there, 200 there, because if the money does not come in up front, you cannot execute the plan that you've designed to spend the money.
Because you're distracted trying to go get more money the whole time, or?
No, because there's no guarantee you're going to get the money.
Uh-huh.
Right? So if my $1 million capital plan calls for me to hire 15 people, but I've only raised 100, am I going to hire 15 people, or am I going to hire like 2?
Yeah.
Right? And then you start executing the plan with the capital that trickles in, but then that's not so much the plan that you designed.
Right. Exactly.
And I think being undercapitalized is a pretty it's a pretty risky proposition. So and that's what kind of happened to us is we raised what did we raise, a couple $1 million over the course of 3 years. Mm-hmm. But if we had $2 million on day one, our growth path would have looked far different, and our decision making would have been far different.
Right.
We did a traditional venture round a couple of years ago, and with the capital coming in up front, it gave us the confidence and runway to be able to really execute. And really executing looks like doing this and then coming out of it, right?
Yeah.
So the more cash you have, the deeper you're willing to go.
Yeah. Well, tell me about that, because I mean, I mean, you've got a plan, you've got the money, and the plan, I'm sure, is calling for, a dip in cash flow, a dip in profitability, but you've got to like trust the plan and the course, right?
Yeah.
Like, at what point are you guys kind of looking around and be like, oh shit, like, this is the plan, right? Like, this is what's supposed to, like, give us a little background on that.
Well, so there's opposing forces at play. You don't want to run out of money, but there's an investor term called capital efficiency.
Yep.
And that calls for you to spend their money because they don't want you sitting on it. If they wanted you sitting on it, they would have just put it into a CD and made a risk-free, low-interest return, right?
Yeah.
So you have to find a balance between being as efficiently as you can with the capital that you're spending without risking, not getting the return and running out of cash. So, I think our approach has always been, we try not to take big bets, right? Like it's a very iterative test, respond, test, respond, right? And grow. And we follow what we call an innovation framework, and it's a sort of a really simple thing.
Okay.
There's 3 parts to it. Whenever we have an idea, we say, well, what's the size of this idea? Is it like a $10,000 idea? Is it a $100,000 idea? Or is it $1 million idea, right? And then we say, what's the investment required to benefit or to execute this idea? Is it going to take a week? Is it going to take a few months? Is it going to be like a year? And then the last part of this, which is the key, is how certain are we it's going to work? Is it like we're 100% certain it's been done before, it's guaranteed? Do we have like no data whatsoever? It's a gut idea, it's a bet? Or is there like some data? Like do we have some, right? And we've never had $1 million idea that takes a day that is 100%
Is 100%
certain,
guaranteed.
right? So that's never happened and never will happen, right?
Right.
But we've had a lot of like, $1 million ideas that we think, will probably take several months and maybe there's like some data and that makes it kind of a difficult, how do we think about that? And the way we think about it is we say, how can we minimally invest to collect more data and just move it through the framework? We don't have to the framework's not a destination. We can take something and just move it through the framework, right?
Okay. Yeah.
So for example, we have a new product concept, right? Do we spend 5 months developing this product and then launching it and selling it and marketing it? We could do that, right? Yep. Or like if we have a good idea what the product is on day one before we build, anything, let's create a little marketing sell sheet. Let's make some phone calls.
Yeah.
Let's create a contract and see if a customer would actually give us a credit card. And if we're successful at that, then we can say, hey, appreciate it, but we're not going to charge a card today because we're looking at probably 6 months before we roll this out, right?
Yep.
So we'll call you back and then. But you've gone through the sales process to sell the idea before you invested anything in building it.
Yep.
And that's collecting data, right?
Yep.
And that's what Bill Gates did with MS-DOS and IBM. Right? It was like he sold it to IBM before any code was written. As if code was written. Right,
exactly. So that comes down to, the sales skills, to sell
100%.
something that isn't even created or real yet.
And doing it in an ethical way.
Right, exactly.
I'm not suggesting you go out and fib and make up.
Right.
But I think we have found very ethical approaches to doing that. And trying to pre-sell something before we overinvest in building something that we don't know if we're going to be able to sell.
How is that aligned with what people refer to as like a minimum viable product, or like?
I think a minimum viable product is the minimum viability to sell a product.
Okay.
Right?
Yeah.
So what does that mean? It means what's the point where you've got enough value to where someone's willing to buy it?
Got it. Yep.
Right?
And then maybe those first time customers, like, hey guys, like we're developing something, we've got something that's basic. Come on, be our first couple customers, steep discount, or whatever and help us build this out.
And those are all data points to collect in this like innovation framework. Like what we try to do is we say, well, let's try to sell it for $1,000 to this guy, $500 to this guy, and $100 to this guy, right?
Yeah.
And see, because you're going to get different objections and you can have different conversations around value and return on value and how they think about it, right?
Yeah, very.
The hardest thing that we had ever done was actually try to sell our product for free when we first started. When we first started, we said, hey, let's not charge vendors because lenders don't charge vendors to partner with them. Like, why would we charge them? And we'd call people up, hey, we're approved, and we have this embedded finance solution that's going to help you sell more equipment, and blah blah blah. And we've partnered with all these lenders, and they didn't know who we were, and they were like, well, how much does it cost? We're like, well, it's free. And they're like, well, if it's free, I don't.
What's the catch?
What's the catch? Or like, I don't know if something something that's free certainly can't be of value. Yeah. Right. So then we said, you know what? Let's charge them like $80 a month. Let's just put a price on it. It doesn't matter. And we said, if you fund $5,000 a month with us, we'll credit it back. And all of a sudden, we started selling them, because once you put a price on it, you create perceived value, and the conversation changes. Mm-hmm. And if I said it's $80 a month, you're thinking to yourself, how do I justify spending $80 a month? But if I said this is $1 million a month, you're going to start thinking about how to justify spending $1 million a month, which is a very different thought process than 80. Oh yeah. Right? And you start thinking about things differently. And I think all that matters in how you position products for market.
That's so cool. Where'd you learn all this stuff? Just through process
a lot of things for both $80 a month and $1 million a month.
Oh man.
I don't know. Student of sales. Just it's an engineer's approach to sales.
How would you describe yourself as a professional? Would you like a technical guy, a sales guy, an engineer, a marketer, a finance? Like, how would you...
I think anybody in small business is all those things. Yeah. Yeah. I don't know if I would define myself as much by what I do as a business owner as much as I do by what I enjoy as a business owner. Okay. So I think I've spent most of my career in working for startups, or really starting them yourself. Up. Yeah. I did very early on work for a large enterprise. I worked for EDS out of college.
I know EDS.
Yeah, Ross Perot.
I didn't know there was Ross Perot.
Oh yeah, yeah. Ross Perot ran EDS, and it was a very large company, and did not like that. And I spent 2 years there, and I was like, I'm not going to work for a large company.
Was that like your first kind of job, or like?
Yeah, I started a company in college, but I wanted to take a corporate job to understand who my customers were going to be for the next 50 years, right?
Smart. Yeah.
But what I think what I enjoy the most is creating, is the value creation part, which has to happen in the early life cycle of a company and continue to happen in later life cycles if you run the company a certain way, right? Right. But I like figuring out a way to get that first dollar in, and then once we're working on getting the millionth dollar in, turn it over to operators that can manage towards process and consistency and detail and KPIs, right? Like I like creating value. So I don't know what that makes me, but
a creator.
A creator.
Yeah. Problem solver.
Yeah. Yeah.
Well, I mean, that's like how many businesses have that paradigm of like, man, what I love and what I'm good at is 0 to 1. It's actually Peter Thiel wrote a book, 0 to 1. I didn't mean to but like I love that 0 to 1 or 0 to $1 million. And then when we get to the $1 million, I'm like, I'm kind of bored and I might screw stuff up if I stick around.
It's true.
Kind of thing. Like,
it's true. And I don't want to like discount founders' abilities to continue to lead a culture.
No, yeah.
Right. But they're not likely to enjoy the operational side of that business as much as they want to stay involved in the new things. Yeah. And or solving, continuous improvement of old things. Right. But to them that feels new, right? So most of my time is spent, figuring out, we look at a business, sort of oversimplify it. What is a business? people, product, process.
Mm-hmm.
And I'll spend a month working on people, spend a month working on product, spend a month working on process, and each three of those categories, there is new and innovative things you can do.
Absolutely.
Right.
So have you, or is it Prove at the point where have you hired like a COO or like an operator to kind of like run the business, and you're focusing more on creation and development and being a visionary? Or
Yeah, we have very capable leadership in place now. Mm-hmm. So we have a chief marketing officer, chief technology officer, VP of finance, VP of enterprise sales. I could step away from this business for a year and it would be just fine.
That's got to feel awesome.
It is. It's good to have very capable people.
Right.
And I think it's also, it affords the company the ability. Somebody's got to be, keeping their foot on the gas of new and
right, exactly.
and challenging legacy, right? That's the big thing. Is like one of the things that I graduated college in the 90s. In the 90s, I went to engineering school, and what was big then was total quality management or quality control, right? And it was, and all that kind of boiled down to iterative design, like put something in place, measure it, and improve it. And we have this sort of saying internally that if it's not broke, fix it anyway.
That's cool. I haven't heard that before.
And everything can be improved, right?
Yes.
And that was a core part of like TQM back in the day.
Yeah.
So that's my job. Like I'm looking to fix things that aren't broken.
That's awesome. I'm sure there's certain days when the people love you, and certain days where it's like, dude, come on, man.
Yeah, well, you also figure out how to do that in a way that doesn't piss people off.
Right.
But that's it's fun, right?
Yeah. No, I love that you brought in the continuous improvement is something that I really do think I'm passionate about it. I mean, it's part of our core values, and I got to learn like lean management and like Six Sigma at a very like technical and operational level when I was working for ABB, and taking that and like trying to boil it down to small business has been really cool, because it's like some people just get it, right? Because some people it's like, dude, it's just logical, right? It's like, all right, don't let perfect get in the way of good. We've got some, let's get it into place, let's make it work, and then we'll, and then we'll make it better as we go. 100%. But we can't just sit around and, wait for something to be perfect, right?
And I think, if founders, I've met founders that are, if they lean real technical, they over-engineer, overthink.
Yeah.
And I think it's because there's a feeling of permanency to their decision making.
Yep.
Where like for me, it's like, hey, let's do this. If it doesn't work, we'll change it.
Yep.
It's not permanent. It's very fluid, right?
Yep.
But then we also have founders that maybe aren't detailed enough. They're too conceptual and can't figure out how to take high level concepts and execute. And I would equate that to not figuring out not being able to break a problem down into its lowest common denominators and figure out what the components are. But being a engineer that immediately went into sales out of school, like I feel like there's a balance of, focusing on execution, but not over engineering. Right?
Yeah, definitely.
Yeah.
Well, I mean, having being able to balance that, having like that engineering background and engineering mindset, but then being able to have the personality to go and sell. I mean, that's a pretty, impressive combination.
It's a good balance. I'm not the greatest salesperson, and I'm not the greatest engineer, so I'm like somewhere. I'm like in the middle,
Yeah. So switching gears a little bit, looking back, when was there a time where like people or like investors or someone were like pressuring you to maybe go a certain way, and you're like, nah, like we're gonna go this way? Like, have you had any experiences where?
I really haven't.
Okay.
I would equate that to both luck and design.
Okay.
So I've been very. I kind of learned early on. You should not take money from anybody that's willing to give you money, right? Like your investors are your business partners, and I think you have to be quite selective about who you partner with. our investors are extremely supportive, and a case in point, most angel groups target a 5 to 7 year return. We're going on year 10, right? So there might be a little bit of deal fatigue for early investors.
Yep.
But raising money is such a weird thing. It feels adversarial until the check is written, and then all of a sudden you're 100% on the same team, as if that never happened.
That's cool.
So you're having conversations, or challenging the business, or questioning your design, or questioning your thought process, or looking for a risk. And it's a very, the TV show Shark Tank. It's very Shark Tankish, right?
Yeah.
But then as soon as they make the decision to give you money,
yeah,
of course their decision's right.
Yeah.
It can't be wrong.
Right.
So now they're supporting every single thing that you do, because it supports their decision to invest in you.
Interesting.
Right? But we have very mature investors. Our investor base are experienced professionals, understand the risks that they're taking, have the ability to take that risk, and then the ones that are have led our rounds have been very active in the business, and I know some founders may not prefer that, but
yeah.
I've built very strong mentor-mentee relationships with our investors. So our current venture capital firm, I meet with the board director every other week, and it's a coaching session.
How cool.
Yeah, and that helps me, right?
That's really cool.
So my thought is take advice wherever you can get it.
Yeah.
And that's worked out really well. And if I had any complaint about our investors, is I wish I could get more advice from the investors. I wish they'd be more active in the business, because that's if you got that kind of brain trust, why not take advantage of it?
Yeah, it sounds like you've done a good job of choosing your investors, and like the alignment on vision, and just I'm sure personal philosophy and like life.
Yeah.
It's probably part of it.
It's worked out really well.
So on the flip side of when looking back in history, and maybe with Approve or with something else, like what was a decision that you made where it was a really good learning experience, where you're like, okay, like I learned a lot from that one?
Yeah. Well, that happened early in my career, and it was the best thing that I've ever done that I'll never want to do again, although I did not realize it at the time.
Yeah, I bet.
And it really has shaped my career and attitude on life moving forward. I helped start a company in Atlanta back in the early 2000s, and we built an online marketplace for manufacturing services. And we did it at a time when online marketplaces was sort of the innovative use case on the internet.
Yeah.
I was the #1 founding employee, designed and architected the sort of initial product, then led sales and marketing for them. And the CEO was a guy that I had met working for EDS. They were a reseller of our software. He ran a company that resold our software, and I was the channel manager at the time, and met him through that relationship. And it was exciting, and he had gotten some very early traction, and I said, man, I want to come down to Atlanta and help build this thing. And I packed up my car, moved from Philadelphia down to Atlanta, and week 1 realized I got myself into a pickle. This guy turned out to be a classic narcissist, like the biggest, like classic narcissist, right? Like incapable of feeling empathy, and would take advantage of everybody to his own benefit, and sometimes take advantage of people for no logical reason other than maybe he somehow got something out of messing with other people, right?
Yeah.
So for the next 5 years, worked with this. I remember calling I remember the first week I moved down there, I called my boss at EDS, who I had a really tight relationship. I said, Barry, I was like, I think I just got myself into a mess with this guy. And Barry's like, do your best. So for the next 5 years, I was trying to, we grew this business, we grew it rapidly, we grew it, I don't know, I probably at one point had 20, 25 people working for me. And it was very difficult managing a group of people when you did not have confidence in the person that was managing you, right? And the business was successful at the time. Matter of fact, we sold half that business to Jeff Bezos.
Oh, shit.
Yeah. So that business at that time, it made a lot of people a lot of money, and it was doing quite well. But I said to myself, I made a very difficult decision. I finally resigned. I finally got to the point where I just could not go to work every day. I was the cancer. I was the cancer in the organization. I knew that's not what I should be or wanted to be, or right. And it wasn't fair. I don't know if I so much cared about the person I was working for, but it wasn't fair to the people that were working for me.
Yeah.
And I made a decision very early on to say, success should not, you want to be successful, but not at all costs. And culture is extremely important. And being happy going to work every day and finding value in not only what you do, but who you do it with, how it impacts others and how it impacts you is really important. So with Approve, we've spent a lot of time and energy, maybe not energy because it's come natural to me. We spent a lot of time focusing on building a culture and environment where people actually enjoy it and want to come to work, right? We got the saying on our website, like, you work something like 90,000 hours in your lifetime. Do you really want, do you not want to be happy spending that, right? So that is just as important to me as the sort of financial quantitative outcome of the business is, all these people that work for Approve or had worked for Approve, would it have impacted them in a positive way in their career? Yeah. Right. Or even outside their career, socially, right? Whatever it is. So it was a really good experience to have at a young age. In hindsight, it didn't cost me as much as I thought it did at the time. Right. But it definitely shaped thought moving forward. Yeah, and I'm sure has been a part of how you built the culture, for all the businesses that you've been involved with. Yeah, 100%. And everything's work hard, play hard. If you got the will and you got the skill, we're gonna have fun doing it, right? Yeah. But if you don't want to show up, we let people go all the time who just, didn't buy into it or didn't. Maybe they said they did, but obviously they weren't. And it's like, look, you're not doing yourself a service by being. Obviously, you're not helping the company, but you're also not helping yourself. And when you get to the point where you're ready in the mindset to let somebody go, you actually feel like you're doing. I feel like I'm doing them more of a service by letting them go than I am a disservice. It's like, hey, you're not going to like me for doing this, and you're probably not going to like me for a while. But like 10 years from now, you're going to realize that might have been a good thing. Exactly. And it had a positive impact on your life. Yeah. Man, you just dropped so much experience and knowledge, and I think it'd be a pleasure to be an employee at one of your companies. I'm sure it'd be fun. It'd be fun. No, it definitely will be fun. And man, thank you so much for taking the time. Yeah, man, I appreciate you having me to come on. I know you're super busy, and for you to come here means a lot. Well, you built an impressive business yourself, and having a positive impact on the community with your podcast. So it's exciting to be part of it. Appreciate it, man. Yeah, man. Cheers.